Hey everyone, welcome to another installment of The Way It Is, and I'm your host, Luca. And today we are carrying on with our sort of new and cutting edge IT platforms that are out there in the world, or at least not so much IT, but new platforms that are out there for involving real estate. And today I have the pleasure of having Stephen Jagger, who is involved with a company called Addie, ADDY, and not even a capital A. And this was brought to my attention by Ben, my audio engineer and podcast guru. And basically, they're a new company that are making investment in real estate accessible to essentially anyone. Hi, Stephen. Welcome.
Hi. Thanks for having me. How are you?
Yes, then. Well, thanks for being here. And you're fortunate. You're out in sunny BC or in Vancouver, if I'm not mistaken.
Sunny, sort of. It's pouring rain right now.
Well, we're raining here too, so we're sharing the same climate, right, for the moment, anyway. So, tell us where Addie started. Is it U.S. based? Did it originate in Canada? How did you come to join the corporation? Give us a bit of the background, then, please.
Sure. So myself and two business partners, a guy named Mike Stevenson and Jeff Booth, started the company back in 2018. So we're a Vancouver-based company. Our office here is in Kitsilano on 4th. And we set out to build a platform to enable everyone to be able to invest in real estate. The goal is to essentially eliminate the barriers to entry so that everyone can participate in ownership society.
So did this stem from personal reasons, like the three of you? Did you have personal situations where you felt you were shut out or didn't have success investing in real estate? What was the sort of...
I think a little bit on the other side of that. Mike Stevenson and I have been business partners for 22 years across 7 different companies now. And so we've basically been building companies since 2000. And we've had a little bit of success here and there as we've continued to grow different companies. And throughout that time, we would personally purchase some real estate, generally Vancouver real estate. And as you probably know, if you're buying Vancouver real estate 20 some odd years ago, and if you held onto it, you've done okay.
You've done really well. Yeah.
Yeah. So you've done all right. And so, we've been sort of kind of part of a lot of that rise of what's happened with Vancouver real estate, and we were able to do that because of the past successes that we had with our businesses. But if you kind of fast forward to today, someone who's when I bought my first property, I think I was 21 or something, 21. It worked. Like you could buy an investment condo and you could put $15,000 down and rent it out, and the rent would work, and it would cover the mortgage and the strata fees and the insurance and maintenance and whatnot. You wouldn't maybe cash flow very much, but it would work.
Yep.
And today, for that same 21-year-old or 22-year-old or whatever, that young person to try and do the same thing is essentially impossible unless you have parental help or this very small, like less than 1% of the population that's in the right role, has an entrepreneur, has the right type of job, whatever it is at that age. A starter condo in downtown Vancouver is $500,000 maybe, but generally $600,000 or $700,000. And it's just very difficult now for people to be able to get involved in the real estate market and participate in that ownership of the asset.
Yeah, no, you're preaching to the choir. I mean, I've done this for 30. I sound like a broken record. I've done this for 34 years, and you're right. I mean, 34 years ago, investment properties were a thing, and I bought several when I was younger, and many did, and but now, fast forward to today, the pandemic, pricing, and now, sadly, in the shadow of interest rate hikes. Cash flows don't make well, there aren't any, and cap rates are I mean, you can't make any sense of them, and who's deciding to, get nothing in return. It boggles the mind, and certainly, in your market area and Toronto and everything else, we've seen a huge influx of investors coming to our market area simply because they're priced out of where they are, right? And unless you're going to an equity position of plus 50%, north of 50%, yeah, that the thing doesn't make any sense. So that brings us then to, and it's awesome that you've come up with this concept and this principle. And I went onto your site and did some reading around, and so essentially, Addie acts as the vessel for individuals to essentially buy shares into an real estate investment.
Yeah. Yeah. Essentially, what we've done is put together a technology platform that enables us to have investors invest as little as $1 into a single, into a specific property, a single address. And the only way that is able to work is we've built all the technology around that to drive those costs essentially down to almost zero, so that yes, small investors can participate in a prudent way into a specific property that they're interested in owning. And so how it works for us is we come in as a limited partner. There's a general partner that is generally, they're purchasing the property, or they're building the property, or they're building the building. And they're usually raising some money from high net worth, kind of wealthy investors. And those investors come in as what's called a limited partner. And so what Addie does is we come in as that limited partner. So we'll take down let's say $1 million slice of the equity stack of a specific property or building. And then we take that $1 million slice and we put it onto our platform, and we enable the community to be able to invest $1 up to $1,500 into that specific property. So they can have $50, $500, whatever slice that they would like, and they can own that portion of that specific property. And so that basically means they'll participate in the potential growth of the property. They'll participate in any distributions or dividends that come out of the property. They will get their percentage share of the cash flow that runs out of the property.
And so why 1,500 as a cap? Just out of curiosity, where did that come
so
from?
it's a good question, and we capped it at $1,500. The goal is for us to enable as many Canadians as possible to invest in these properties. So we want to get to 10,000 people investing per property. Right now, we're anywhere from 900 to 2,300 people will invest in a specific property. Our goal is to continue to increase that number to 10,000. The $1,500 mark is generally not much of an issue. Our average investor invests about $400 per property. So the vast majority are not bumping up against that $1,500 cap. We do have an accredited investor program. So accredited investors can join as an accredited member on the platform, and they can invest more than the $1,500 limit. So accredited investors can do, 10,000 or 25,000 or whatever they like per property. And we build that into the capital that the slice that we're going to get from the general partner. So if we're comfortable that our community is able to take down $1 million slice, and if we knew we had $500,000 of accredited investors that would like to participate, we will take a $1.5 million slice from the general partner.
Okay. And once a member or an individual takes, their share of a particular property, that doesn't restrict them from going to the next property as well, right? They can participate in as many properties as they want, correct?
Yeah. So we've done 25 properties so far. We've got lots of people, myself included, that are in all 25. And so we stay away from individual condos and single family houses. We don't do those types of properties. We're strictly focused on institutional commercial grade real estate. So multifamily apartment buildings, mixed use buildings, industrial business parks, commercial business parks. We've got a couple hotels in Montreal. We've got an RV resort 2 hours outside Toronto. So the opportunities range. We've got properties in BC, Alberta, Ontario, and Quebec. And that's the idea, is that people can diversify their investments across these individual properties that are some are lower risk, some are higher risk. So we've got development opportunities that come on where people can invest in the property before the hole has even been dug to build the building, or you can invest in, like, we've got a Starbucks in Chilliwack, BC, which is about an hour and a half from Vancouver. It's a brand new single commercial building that was built for Starbucks Canada. And so Starbucks is the tenant. They've got a drive-through, and we've got 833 investors in that property. So those investors are getting quarterly distributions or quarterly dividends out of that property, which essentially is coming from Starbucks's rent. That's and so people that buy their coffee from that Starbucks help Starbucks pay the rent on that location, and the distribution comes out the back end.
So you need some knowledgeable people on, I know the three of you have experience, but do you have a staff then that goes and vets and curates these properties then? How do you come to find them and obviously you have to do some kind of screening process or analysis process on each of these potential portfolios, right?
Yes. Yeah. So we've got an acquisitions team, and the real estate acquisitions team essentially reviews all the due diligence for a property and then underwrites the deal. But I think more importantly is when we're looking at a potential partner, is we do due diligence on the general partner first without looking at the deal. We're interested to understand who the general partner is, what's their skill set, what's their background, what's their history, what are their core values, like what do they do when things go wrong, how have they acted in the past, what's their reputation like, to try and understand, are our core values aligned with their core values, and are we going in the same direction? And if all of that checks off through that kind of rigorous process to try and understand who they are, then we look at the opportunity and we'll look at the property. And then the real estate team will then dig into the deal, get all the paperwork, go do a site visit, and put together our own due diligence and research on the property to try and understand, is it something that we would like to be involved in? And if that is true, the end result is what's called an offering memorandum. And so we put together an offering memorandum document. It's a 45, 50-page document that summarizes the deal, breaks down the risks, the opportunity, the plan. And that is what goes onto our platform. So our members can log into their Addie accounts and then review the opportunity, review any of the projections, read the offering memorandum document, and understand what's the plan for this property. And then they can make an investment decision, and they can invest like literally as little as $1.
Yeah. So, and that's very timely given the headlines in the CBC these days, right? Where there's some poorer souls in the GTA that, put some significant dollars down into condos or whatever. And now they're, looking on the outside in and potentially looking at some significant losses because the developer, whoever's now gone insolvent or, is whatever, can't be found. So I guess, and I'll play devil's advocate because I'm uber intrigued. I'm actually, when I was on your website today, I was going, geez, maybe I should just become a member and start throwing $1,500 around into these different portfolios. And I know every property is different and every acquisition is different, but what have been some returns? Like you talked about that Starbucks scenario and people are getting quarterly dividends. On $1, I dare say, you know what I mean? Money in, money out, right? So, give us a sense of, is there a point where you're getting optimal returns for the optimal investment? Maybe give us some insight into that.
Yeah. So a couple of things there, I guess. We've got lots of realtors on the system, that's for sure. There's lots of opportunities, just like myself. Like I live in Vancouver. For me to have opportunities to invest in a Montreal hotel, it's like, where am I ever going to do that? It's not, when am I going to get involved in an apartment building in Toronto? Like it's just, and vice versa, or people in Calgary that want to get into the Montreal area, like it's just, we enable people to invest in their backyard and be a part of that, but also to invest in other places where maybe they don't have any exposure. As far as returns, or maybe I'll step back one. The reason we do the dollar is it's not meant to be like a marketing thing around as little as $1. The purpose of that is we're trying to eliminate barriers to entry so that everyone can participate in real estate. If we said the minimum investment was $100, but you had 80, all of a sudden we are the barrier to entry and we're the ones blocking you from participating. And so by saying it's $1, it's like whatever works for you. If $25 per property works for you, $100 per property works for you, like whatever you choose to do is your choice, and people can make that prudent decision based on what's going on in their world and how they feel about the opportunity, or they could choose to not participate in that one at all. And then as far as returns go, we've done 25 properties so far. I think 3 of them have started producing dividends. Like the Starbucks in Chilliwack I mentioned has done, at this moment, has done 5 distributions. So 5 quarters of dividends or distributions coming out. We've got a business park in Calgary, 11 building business park on the northeast side of Calgary that's also done 5 distributions that have come out of that. So that's 5 quarters of funds flowing back to the investors of those properties. And then we've got another one called the Lex, downtown Vancouver. It's a mixed-use, 45-unit mixed-use property. The original plan was for the investors to hold the property for a projected 5-year term. And what's happened is the general partner, the building was already stratified, but it was running like an apartment building. And so the general partner chose to sell off all 45 individual condos as well as the 2 commercial units on the main floor. And so that has completed. And so they're waiting on the last couple of deals to close, but all of them have been sold. And so we're going to be out of that property in about 10 months or 11 months. With a significantly higher return than like we were, I think, projecting 5% IRR, and I think it's going to come out north of 20 in like 11 months or something like that. And so there's a blog post on our website that we keep updating with, because people ask this question all the time. It's like, well, what are the returns and what's happened in the past? And so we've never exited a building. The Lex, that one will be our first exit to be completely out of a property. Mm-hmm. We do have 22 other properties that haven't produced any income back to anybody, or no distribution or no exit yet. Some of those properties will do, or are projected to do, annual distributions. So they should be coming up anytime where an annual distribution will come out of them. Other properties have no plans for distribution because the building is either being built and there's no revenue coming in to do a distribution, or it's a property that's going through a massive renovation and there's no point in spitting out cash out of the property when you can use that cash to renovate the buildings or the units or whatever it is. So each opportunity is different. That's kind of the fun of it, is people can, dig into the property, have a look at the general partner, read the offering memorandum, and then just make a decision if they like it or not.
Well, and then that is extremely interesting, I guess, and to have that sort of opportunity for variety, I suppose, right? And I mean, I did scan through the prospectus document there, and I think if I'm not mistaken, I saw something about a 10-year commitment. But I guess that is there a length of commitment determinant? That's a determinant based on each property, I guess. Is that a minimum? Yeah. Like you have to stay in it for 5 years, you have to stay in it for 10 years, type of thing.
Yeah. So, and those are projections. Like the Lex was projected at 5 years and it's coming out in 11 months. Right. So they're projections. The general partner, when they put together their plan as to why they're either buying the property or building the building or whatever it is, in the offering memorandum, it'll say, we think we need 10 years, or like the commercial business park in Calgary is a 10-year projected hold. We got into that just over a year and a bit ago, and Calgary was still, the vacancies were very high. Oil was, not doing too much. And now it's funny, like a year and a bit later, it's changed. Vacancies are still high, not as high as they were, but oil's totally changed from a year and a bit ago. And so, but that's the idea. When they were looking at it that time, they thought, their plan was like, we're going to need 10 years to be able to do what we want to do with this property over this period of time, where like the Montreal hotels are both 2-year projected holds, so much quicker, because they're much smaller buildings, and they're going to basically taking an old mom and pop type hotel and converting it into what's called a smart hotel, where the whole hotel is automated. You open the doors and you check in, check out all through your phone. So once they've converted all that small, they're like 20 to 30 unit hotels. Once those are converted over, they can actually start operating as a smart hotel, and we should be able to get up much, much quicker. So like I said, each one is a little bit different, and those are all just projections. It's important for people to know it's a projection and an estimate based on, that moment of time of what that offering memorandum says, and it breaks down what the plan or the thoughts around the plan, as well as any of the risks.
Right.
And then obviously sometimes things can change and things can go faster, things can go slower. But yeah, that's the idea, is we'll keep bringing on properties onto the platform so people can keep choosing which ones they like and diversifying their real estate holdings across the country and across the different assets classes across the country.
Have you ever had a situation where you didn't sell it out and you didn't get enough people to buy in?
No, when we come into a deal so we like to call our funds differentiated capital. And I can explain what that means in a sec, but the big piece of it for the general partners, we guarantee the funds to them. So if we say that we're in for $1 million slice, we're in for that $1 million slice. And so they're not crowdfunding anything through us. We've said to them, we're good for the money, we're in for it. So if we put it onto our platform, we've had properties sell out in 60 minutes. And then other times they've taken a month or so. But from the GP, the general partner's point of view, we've already made the commitment. So either we've got flexibility on the funds and we can give it to them when we are sold out, or we've advanced the cash before we put it onto the platform or before we've sold it out on the platform. But from the general partner's point of view, there's no risk in them getting a phone call from us saying, hey, we came up short. That's not an opportunity, or not something that would happen. The other side of it is, like I was saying, we consider ourselves differentiated capital, meaning we're more than just the $1 million check.
Right.
There's lots of people out there that can cut, $500,000 or $1 million check into these developments or into these properties. And this is where generally those general partners go, is they go to those high net worth individuals. They show their plan. They say, this is what I'm going to do. I'm raising $5 million. I'm looking for 5 $1 million investors, and 5 people will cut those checks. And those people will be able to do it again the next month and the next month and the next month. And that's where they generally get a lot of the capital. And so what we do is we'll take down one of those LP slices. Let's say it's $1 million. Mm-hmm. But the general partner is getting so much more than just the money with us, right? The Montreal hotels are a great example. We've got a couple thousand investors now participating in the ownership of those 2 hotels. And the way the GP looks at it is like, if you're ever going to Montreal, why wouldn't you stay at your hotel? Mm-hmm. Like, why would you not do that? Or if your friends are going to Montreal, why wouldn't you say, hey, you should check out my hotel. I own a piece of this hotel. And so now he's got 2,000 people out there talking about whichever one, some of them own both, of those hotels that they own. Like, we see it with our Chilliwack Starbucks. We know we've got 833 investors in that Starbucks. We know people are driving past other Starbucks to get to their Starbucks, right? Because they just want to be in their drive-through. We get selfies all the time, people taking in their cars from the drive-through of them buying coffee. I do it as well. Like, if I'm driving out that way, I'd probably pass 50 Starbucks to stop at my Starbucks. So we know we drive economic benefit to the commercial tenants. Another example would be apartment buildings. So we've participated in a handful of apartment buildings. Generally, if you're a renter in an apartment building, you're a renter. You've got a tenancy agreement and the landlord owns the building. You pay your rent for your space and that goes to the landlord. When Addie gets involved in an apartment building, we put that slice of equity on the platform. We have now tenants are able to invest in the building that they're also a tenant or a renter in. So it lets them be on kind of both sides of the fence when it comes to the ownership of the building. And so now these people will get distributions that come back to them from the building, and that's essentially coming from their rent. And the better the building operates, the better it's maintained, the more profitable a building is to operate. And so these are the types of benefits that come with us that your average wealthy investor cutting $1 million check just cannot provide. Right. The last one I could say would be,
excuse me,
we've got lots of general partners, especially developers that are building buildings, trying to find ways to enable their employees to own a piece of the building that they're building. Right. They're doing all the work. They're the carpenters. They're pouring the concrete. They're doing all that stuff. But at the end of the day, they just get a paycheck. And so we've got lots of developers now coming our way saying, well, I'd love to figure out a way to have my workforce, my contractors, my accounting staff, my whoever, to be able to participate in the ownership of this building. And when it goes well, instead of me and my wealthy investors sharing, we can all share in the benefits and the upside of a successful development. And so we're essentially able to enable developers to have, in the tech world, is an ESOP is a common thing. There's an equity share program where your employees, you can incentivize your employees to work for a tech company and you get shares in the business. It's pretty common in the tech world, but
Yeah.
it's not very common in most other industries. And so having Addie involved in your property can enable that to happen, where our technology does all the heavy lifting to let 500 or 1,000 of your employees participate in the opportunity.
Yeah, no. I mean, that's not, and what better way to incentivize and, especially the scenario you just described, where the guy that's banging the nails or doing whatever to make sure that he's going to do a good job that day when he's on the job site and everything else, right?
Yeah.
So, no, I mean that's yeah, that's quite yeah. It's quite an intriguing concept for sure. So now I got on your site, and I know you obviously repeat this a lot because the one question you almost reiterated verbatim. But so there's one here that I'm pretty sure you want to get out, because I know there's some people out there is Addie a REIT. So an REIT, which is a registered, I can't even remember what the acronym
Real estate
stands
investment
for.
trust.
Thank you. So, and it's not. So explain the difference there.
Yeah. So a REIT is like a basket of properties, where Addie is an individual property. So if you invest in, there's lots of REITs in Canada and the US. If you invest in like the Canadian Shopping Malls REIT, you'll own, it's a publicly traded thing that you can invest in, and you'll own shopping malls across the country. So they might have some in Vancouver, Calgary, Edmonton, Winnipeg, Saskatoon, Toronto, Montreal, like wherever, just all the way across. It's you're in the retail space of shopping malls across the country. And so it's a cool way to own Canadian shopping malls if that is what you're interested in. That's awesome. The big difference between that and what we do is you either like that Chilliwack Starbucks, that single one building, you either like it or you don't. And if you do, and you want to own a piece of that property, you can through us. You're not getting all Starbuckses. You're not getting Starbuckses in shopping malls. You're getting that specific one, that one building, or the Lex building downtown Vancouver. You either own that one or you don't. You're not getting a whole package and a whole basket of a bunch of multi or mixed use buildings in downtown cores. You're getting the specific property. And so we essentially enable people to choose the specific property. And if they like it, they can participate in the ownership of that building, and they don't have to have a whole bunch of other things that they may or may not want to own along with it. And so it's not that a REIT is good or bad. It's just we're significantly different in what a REIT offers versus what Addie offers.
Okay. So I just want to circle back quick because you talked when you were talking about differentiated capital, and you say you make the commitment to the GP for X, 500,000 million, whatever that slice is. I guess going back to my original question, what if Addie doesn't sell out to meet, you know what I'm saying? To
then we'll own
guys. Okay. So, and that doesn't change anybody's in terms of potential returns or cut into that because
if we took $1 million slice and our community took down 800,000 of it for whatever reason, they weren't interested in the rest, we would own the other 200,000.
Okay. And that's not borrowed capital that's going to dig into or affect any of the investors or anything like that in terms
it comes from the Addie, the corporation itself.
All right.
And that's one of the reasons we're structured in the way that we are, so that we can provide that guarantee to the general partners. Because there's, these guys, some of them they're trying to raise a bunch of money for a deal, and they just can't think that they're done and have someone come up short for their $1 million slice. You just never get asked to participate again because you put them on their heels, and then they have to go quickly figure out where to get the rest of their money. So it's very important for us to be able to say, no, if we say that we're in, we're in. And many times, because of our differentiated capital, the general partners are quite flexible with us, because they understand that we're worth more than just the $1 million check or $2 million, whatever the amount is. Because of those things that we talked about, is we can enable their employees to participate or the tenants to participate, or we know we're good for the commercial tenants if they are certain types of commercial tenants, obviously. But there's a lot of these extra benefits that we provide because of the differentiated capital.
So, what is the worst case scenario? What could someone risk putting in $1,500 and just never getting anything back on it?
Yes. Yeah. It says it's in every offering memorandum document you can see it says you are signing off saying the risk is your investment amount. So if you're putting $500 investment into it, you're putting $500 at risk, not more. But you are putting a $500 investment. 100% of it is totally at risk.
And
And so that's why you can see when we put a property out there, there's a different risk level between owning that Starbucks building in Chilliwack that was brand new, built for Starbucks. Starbucks was already tenanted. It's like a 2-year-old building when we came into it, and Starbucks is on a long-term lease. That would be deemed a lower risk opportunity than this development that the hole hasn't even been dug yet. We're going to dig the hole, then get construction financing, then get this, then pre-sell condos, or whatever the thing is. That's much higher risk. And generally, the returns can be a bit higher, much higher on those opportunistic deals, but they come with higher risk. And so that's why we put all of that information out there so the community can make a decision on what types of properties and what types of opportunities are they interested in participating in.
Okay. Now, I didn't, and again, I didn't pour through the offering memorandum, but I'm going to guess, though, at some point in time, somebody may want to cash out. What is there a process to that? If someone finally said, I've been in it for 10 years now, I just want my capital back, or are there restrictions against that, or what happens?
Yeah. So once you've made an investment, the Securities Commission requires us to give 2 days rescission rights, where you could wake up 2 days later and be like, I don't like it, I want my money back. With Addie, we give, that's the requirement, to give 2 days. And with Addie, we give everybody 60 days. So we say, you've got 60 days to just think about this. Now that you've got your investment, you can do a rescission within 60 days. But once that 60 days is passed, you are locked in for the projected term of the property. Because that money, it's not like we have it. The money's gone and been invested into that property. And the general partners either bought the property with the money, building the building with the money. They're doing whatever they're doing, depending on the property. And so you are in for the projected term.
Right. And presumably, though, the shares, for instance, could be willed or transferred. No, if somebody wanted to, or during that before the term is over, or no, that you're locked in.
Yeah, you would basically list it in your will. We've got a blog post that talks about it. You can list it in your will like any other asset that you own.
Okay. All right. Well, that's awesome. So, it's already at 30 some minutes, so I don't want to keep you. But why wouldn't someone not invest with Addie? I guess. I mean, it seems like obviously a very painless, both financially, emotionally, risk-wise way to dip your toe in the water, so to speak, I guess, right? So
why would someone not do it?
Yeah.
The easiest reason I think why someone would not do it is we haven't unlocked their province yet. So right now we're open to BC, Alberta, Ontario, and Quebec residents. So if you live in Saskatoon at this moment, you can create an Addie account, but you can't invest. Our goal is to unlock the whole country. And so we have to do that province by province with the way the securities works here. Mm-hmm. So we just unlocked Quebec 2 months ago. And so as part of in Quebec, as an example, we do the offering memorandum in French. And so each province has different reporting requirements, different rules, different things that require us to do that. And some of them and many of those things have costs involved. And so when we're unlocking a province, we're just working to make sure that we've got enough participation from that province. And so that's probably the biggest roadblock people have, is they live in a province that we're not open for yet. That would be their reason to not be able to participate. But other than that, as long as you're the age of majority in BC, Alberta, Ontario, Quebec, you can invest with Addie. And I think it's also important to note is we're a membership-based model. So we charge people $25 a year to be on the platform. And that's what gives you the ability to invest. That's it. There's no lift on the properties. There's no promote. There's no assets under management fee, no transaction fees, no withdrawal fees. There's nothing. We don't charge any fees. So we're shoulder to shoulder investing in these properties with our community. And the cost to them to be on the platform is $25 a year to be a member.
So, and that segues into, I applaud your philanthropic, platform, but Addie has to make money. You have to make money. Your partners have to make money. The real estate acquisition team has to make money. Your administration has to make money. Where are the profits generated from? Is it purely in the slice, that portion that Addie takes, that in terms of the principals investing in these acquisitions?
No,
Or
no, we take a small ownership slice of each property. We used to take a little bit larger at the beginning, but now that we're 25 properties in, we take a small slice of each property, so that we are in the deals with our community. The membership model is, we think, the fairest way for us to have this platform work. Like, it's very normal in the REIT world and in syndication, real estate syndication. There's fees generally everywhere. And we are super unique in what we do and how we do it, and that we are not built that way. We operate more like Costco, where the membership is the model that we use for revenue for the business. And so we're just working to grow our community and enable as many Canadians as possible to be able to participate in these opportunities. And right now we launch 2 to 3 properties per month, and soon enough we'll be doing 1 to 2 a week. And after that, it'll be continue to get faster.
yeah. And how many members would you have now across Canada and the provinces that you operate in?
We don't publish the membership numbers. You can see we do publish the number of members that participated in each property. So when you click into any of the landing pages, it'll say 962 people invested in this property for an average of $367.
Right.
That detail is all there. We also have a Discord server set up. So a whole whack of our members are in Discord chatting with each other. And so each property has its own channel. And so you can go, if you're an investor in one of the Montreal hotels, you can go into that hotel's channel in Discord, and there's a whole bunch of the members in there chatting with each other about the property. Half the time, the general partners are in there chatting about the property, about what's going on. They're sharing photos of any renovations. And so people can get an idea of the membership, the size of what's going on, as well as the number of investors participating in each property in real time. When a property is available, you can see it in real time. Like right now, I can tell you there's a property in Airdrie, Alberta on the platform that we have a $652,500 equity slice of.
That's the one I saw today. Yeah.
Yeah. So we've got just less than $39,000 left available in that property. And as of this moment, 1,440 Canadians have invested, an average of $329.54. And that is all publicly available on the website. So every property shows that amount of detail as to who and how many, or not who, but how many are investing and how much the average investment is.
Yeah. Well, Stephen, that's awesome. And thank you so much for your time today. I really appreciate you giving us this information on this, I guess, relatively new, but burgeoning business or at least real estate investment platform. My eyes are open. I consider myself an entrepreneur, and I'm pretty excited by what I hear. I'm not going to lie to you.
Awesome. So I look forward to seeing you on the platform. You can.
My only other question is: do you need anybody on the real estate acquisition team or anything like that? Because I'm willing to relocate. I know lots of people. I have family and friends in Vancouver, that's for sure, or at least in BC anyway. But
yeah, well, we're looking for opportunities all over. So yeah, definitely. If you see things that might fit what we're looking for, that would be awesome.
Well, you know what? I will definitely file that in the back of my brain for sure. But listen, thank you so much for your time. I wish you every success, and maybe we'll be in touch again and circle back and see where we go from today. So, all right, enjoy the rest of the rainy day. I'm going to go home and it's late here in the day, but go home and have a glass of wine and have some dinner, and we'll go from there. So, thank you again, Stephen. Really appreciate it.
No problem. Thanks for having me.
Okay. Take care.